Good afternoon, everyone, and welcome to the March 2025 edition of Epic Insight. This is Joe Corona, and I'm the Director of Sales and Strategic Partnerships at Epic Retirement Plan Services, and I will be your host for today's call. As the healthcare and retirement industry continue to evolve, the health savings account has become an essential tool as a part of overall financial planning. Understanding the advantages an HSA can bring to your clients is an essential part of building a comprehensive financial wellness solution. With that in mind, we are excited to have joining us our very own Paul Oakford. Paul is the Senior Manager of HSA Services at Epic Retirement Plan Services. In this role, Paul leads the team in all aspects of health savings accounts, including program development, client relations and administration, the web experience, and employer and employee HSA education. He also works with advisors, banks, trust companies, healthcare brokers, and other financial institutions to help educate them on the benefits of HSAs and consults with them on how HSAs might fit within their practice and add value to their clients. Paul has been working in the employee benefits industry for over 20 years. Since 2004, he has specialized in the area of HSAs and consumer-directed health plan strategies. Paul has been featured as a speaker at national industry conferences and regularly hosts webcasts to help educate advisors, employers, and employees on the benefits of HSAs. As a reminder, your line will be muted throughout the call, but if you have any questions you would like addressed at the end of the session, please enter them in the webinar control panel, and we will address them at the end of the session. With that, I will turn it over to Paul.
Thank you, Joe. Once again, I want to say thank you to everyone who has logged in and joined our webcast, and we appreciate your time and taking time out of your busy day to join us to learn about HSAs and our MyHSA health savings account solution in particular. So in today's webcast, I'm going to talk about what an HSA is, how they work, and then I'm going to go into some industry numbers to kind of let you see how the HSA industry is performing. And then we'll end it up with some information on our MyHSA health savings account solution. I've got a lot to go over, so some of the slides I may go through quickly, but if you have questions, please let us know, and we will try to get through this in time to leave a little time at the end of the webcast to take your questions. So this first slide is really just kind of some information on Epic. You know, we work with a lot of employers and a lot of employees in retirement plans and HSAs, and this is just kind of paints a nice little picture for you of that. Let's start out with what is an HSA? Well, HSAs were created in December of 2003, so they have been around for a long time. An HSA is an individually owned account. It cannot be a joint account, so only one person owns that. In addition, an HSA is not an employer-sponsored plan, and because of that, they're not meant to be subject to ERISA. An HSA also is not a use it or lose it type of an account. So some of you may be familiar with the medical FSAs or flexible spending accounts that have been around for a long, long time. Those are use it or lose it. At the end of the year, what money you have in a medical FSA gets forfeited by the employee. In an HSA, any money you have in at the end of the year stays in the account, and hopefully you continue to contribute to it, and it will grow and grow. And you know, the ultimate goal is to have enough money in your HSA to take into retirement to pay for your retiree medical expenses tax-free. And in addition to that, an HSA travels with the employee should they terminate their employment with their employer. They take that account with them. But here's the best thing about HSAs. triple tax savings. I am not aware of any other tax savings vehicle out there that works as great as an HSA. First, contributions go in tax-free. Earnings on those contributions grow tax-free. And then no matter what, if you take money out for a qualified medical expense, it comes out tax-free. So if you're using your HSA dollars for qualified medical expenses, you'll never pay taxes on that money. So it really is a phenomenal type of vehicle. Let's talk about who is eligible to open an HSA and contribute to an HSA. Well, there's really just 4 requirements. You have to be enrolled in an HSA qualified health insurance plan is number 1. Number 2, you cannot have any non-qualified insurances. And an example of a non-qualified insurance would be a medical flexible spending account. A full benefit FSA would be a type of non-qualified insurance. Third, you cannot be enrolled in Medicare. And fourth, you cannot be claimed as a dependent on someone else's tax returns. How much money can someone contribute to their HSA? Well, as you can see on my slide, I still have 2024 numbers because, like an IRA, HSA account holders have until April 15th of the current year to make contributions for the previous tax year. So let's focus on the 2025 numbers because we're real close to the deadline. The IRS also breaks up account holders into 2 categories, individual and family. And that's based off of how you are enrolled in your HSA qualified health insurance. If your health insurance covers just you, you are considered an individual in the IRS's eyes. If your health insurance covers you plus at least one other person, the IRS will deem you as a family and you can make the family contribution. So in 2025, the individual max is $4,300 and the family max is $8,550. And excuse me, and anyone who is 55 or older, whether they have individual or family, they can do an additional $1,000 catch-up contribution. So let's talk about somebody who becomes HSA eligible mid-year. So let's say they enroll in their HSA plan, health insurance on February 1st. That would be considered mid-year. They have 2 types of ways to make contributions. They can prorate their contribution, meaning they put in 11/12 of the maximum, and then they're fine at the end of 2025. They can also fully fund their maximum contribution. If they do that, they are subject to a testing period, which means they have to remain HSA eligible or qualified for all of 2026. Comparability rules. So what this is, if the employer is making an HSA contribution to their employees' HSA accounts, the IRS says they have to make comparable contributions, meaning what they give one employee in a specific classification or group, they have to give all employees who are in that same classification or group. Now they can break that up into things like full-time versus part-time. They may say, hey, we don't want to give part-time employees anything. So they can absolutely do that. Or they can say, obviously, HSA eligible versus non-HSA eligible. They can't make contributions to non-eligible people. Most people, they break it up by, in our experience, most people break it up by individual and family. Other employers will break it up by the health insurance coverage, self-only, self+1, self+2, and self+3. So that is the typical way they break it up. There are also 2 types of HSA contributions. There are pre-tax and there are post-tax. Now, if in order to make a pre-tax HSA contribution, the employer must include their HSA in their cafeteria plan. So if they do, there's a lot of advantages to doing it that way. One is both the employer and the employee will save the 7.65% FICA Med-FICA tax on any money that the employee contributes to their HSA through payroll deduction. Plus the money comes out of the checks pre-tax at the point of payroll deduction. The comparability rule that I just talked about doesn't apply. But they are subject to the cafeteria plan non-discrimination rules. So the employer can't favor highly compensated employees or key employees over the normal rank and file employees. So that's something to be aware of. But a cafeteria plan really adds a lot of benefit when you include the HSA in that. Post-tax contributions. So these are contributions that are made with after-tax dollars through payroll deduction or some other way. But if an employer makes contributions this way, the 7.65% FICA Med-FICA tax goes away. They don't get that additional tax savings, and they have to apply to the comparability rules that I talked about in the last slide. Something else that the IRS has done is they've made it available to do a once in a lifetime rollover from a traditional IRA into an HSA. Now, unfortunately, you can't roll your whole IRA balance into your HSA. That would be phenomenal, but they have put limits on it. So you are limited to the maximum amount that you are eligible to contribute that year. So if you are under the age of 55 and you've got family coverage, the most you can roll into an HSA from an IRA is $8,550. If you roll that full amount into your HSA, you cannot contribute anything else to your HSA. And that includes employer contributions. So if you roll everything from an IRA in to max it out, you would be limited on, you couldn't do anything else into your HSA. And a rollover has to apply to the tax year in which it happens. So you can't roll over money for a previous tax year. And there is a testing period. So if you do an IRA to HSA rollover, you have to remain HSA qualified for the 12 following months. Distributions from your HSA. No matter what, if you take money out for a qualified medical expense, it comes out tax-free. I said earlier that an HSA can't be a joint account. It's an individually owned account. However, the account holder can use their HSA dollars not only for their own qualified medical expenses, but also for the qualified medical expenses of their spouse and any qualified dependents, all tax-free. You can, however, take money out of your HSA for a non-medical purchase. So let's say you needed to have a big screen TV and you wanted to use HSA dollars to do that. You absolutely can do that. If the account holder is under the age of 65, they're going to pay a 20% tax penalty on that distribution and ordinary income tax on that distribution. When the account holder turns 65 or older and they take money out for a non-qualified distribution, the 20% tax penalty goes away. All they pay is ordinary income tax. So for non-qualified distributions after the age of 65, an HSA works a lot like a traditional IRA, and that gives the account holder more flexibility in how they want to use their HSA dollars in retirement, which makes HSAs, I believe, a really important piece of an employee's retirement strategy. A couple more things. Distributions from an HSA do not have to happen in the same tax year that the actual medical expense was incurred. So if you've got the ability to pay for all your medical expenses with after-tax dollars or non-HSA dollars, you can do that in maybe 5, 10, 15 years from now, pull out that shoebox, add up all those receipts that you've never reimbursed yourself from your HSA for, and take a lump sum distribution later on in life for that. So I think that just gives, it gives the account holder options. They hopefully are maximizing the growth of their account by dipping into their HSA as little as possible. So that's just a neat thing that they've allowed. And then in addition to that, there's no RMDs with an HSA. So we've talked about how an HSA works. Let's get into some industry level data on HSAs. There's a company out there called Devonair Research. They do a mid-year and a end-of-year analysis of the industry every year. I'm going to be using the 2024 mid-year information over the next several slides. I was hoping that they would have their year-end stuff available, but they haven't released that yet. So we get the mid-year stuff. But from their mid-year analysis, they have concluded that there are over 37.6 million HSAs out there in the market today. So it's a large number of people that have HSAs. And they also have said, well, the growth has been moderate, but it's still growing about 5% of new accounts are growing by about 5% year over year. So it's slowed a bit, but it still continues to grow, which I think creates opportunity for advisors and people who want to go into employers and talk about HSAs. Here is this slide. They've also concluded that there's over $142 billion in HSAs. That's a year-over-year increase of 18%. And if you're looking at this slide, you can see that they have also estimated this out to 2026, where they're estimating that there's going to be close to $175 billion in HSA assets. So a lot of money's out there. And if you look at the blue, and I'm going to talk about this in a little bit, but the blue is the money that's just being held in bank checking accounts, and the green is money that is going into investment accounts. So here, same as of mid-year, they estimate that there is over $56.2 billion being held in investment accounts within HSAs. And again, they estimate out to 2026 that that's going to grow to almost $80 billion in invested HSA assets. So there's 56.2 billion estimated in HSA assets as of June 30th. That is an increase of 39% year over year from the last time. So they're growing, more people are putting money in. There's only 40% of the HSA assets are invested. So that tells me there's a great opportunity for advisors if you are incorporating HSA into your retirement plan conversations to talk to employers about, hey, how can we get more money invested and get these accounts bigger? I think it may open up doors for you to get into clients to not only talk about HSA, but talk about 401ks as well, because not a lot of people are having an HSA and 401k conversation with employers. Some more key information that came out of the Devonair report. The number of HSA account holders investing continue to grow. There are about 3.2 million HSA investment accounts out there that make up about 9% of all the accounts. So that's a low number. Only about 9% of the people are actually investing their money. So again, it's another opportunity to get in and talk to employers. The withdrawal rate from HSAs is actually slowing down as well. So that's a great sign. HSA account holders contributed $31 billion to their accounts in the first half of 2024. That's an increase from the prior year by 6%. And withdrawals, they only did about 20 billion from their accounts during the same period, which was down 2% from the year before. Other key findings, employer contributions, they continue to rise for HSAs. The first half of 2024, employer contributions were about 29% of all HSA contributions, and the average employer contribution was $706 per employee. And the employee contributions, the first half of 2024, contributions were they make up about 58% of all the contributions that went into HSAs. And the average employee contribution for the first half of the year was $1,363. So it's growing. They continue to grow. The number of accounts continue to grow, and the assets are growing, and people are continuing to put money in. Again, another sign that, hey, this I think is a good opportunity for advisors. With over $82 billion, I kind of go back to that slide that I showed on total assets with the blue and the green. $82 billion of the $142 billion are sitting in bank checking accounts, earning next to nothing. And a lot of that is based on the lack of education. Employers don't necessarily understand their HSAs. A lot of them are coming around, but there's still a lot out there that don't understand how they work, and they don't think of them as part of a retirement strategy. So if advisors are really picking this up and including HSAs in their conversation, again, I think it just creates opportunity, not only for HSA, but for also new 401k business, because that may get you into an employer that you haven't been able to get into because nobody's ever talked about HSAs. But Fidelity also does a study. Every year they look at how much they think a person is going to need in retirement to pay for their retiree medical expenses. Well, they determined in 2024, a 65-year-old that retires is going to need about $165,000 in retirement to cover their retiree medical expenses. And HSA is a great way to start saving for future medical expenses today. So that's another reason why HSAs really should be part of an employee's retirement strategy. So that's it for the industry data, pretty much. I want to get into the typical HSA solution. The vast majority of HSAs out there start out with a basic checking account that pays little to no interest. All contributions and all distributions flow through that checking account. If there are investments, it's going to be in a completely separate brokerage account that most do not communicate with the checking account. So if the account holder wants to invest, they have to funnel money from the checking account into the brokerage account. And if they need access to their invested money to pay for qualified medical expenses, they have to go in, select which funds to sell off, and transfer it back to their checking account in order to get access to it on their HSA debit card. It's kind of a clumsy process. That's why I think only 9% of the people who have HSAs are actually participating in investments, because it's just not easy. So then they keep low balances, and they use this as a health spending account instead of a health savings account. So now let's get into our Epic's MyHSA health savings account solution. Obviously, we do a great deal in the 401k world. So we created an HSA 401k inspired solution. It really is just one account. It holds both cash and investments. There's a very low cash threshold, so that actually the most cash someone can have in their MyHSA solution is only $200. Once they contribute more than $200, that money gets automatically invested. I'm going to talk about the investment options in just a little bit, and we also realized that account holders need access to their invested balance to pay for qualified medical expenses. So we make it easy for them by giving them access to between 95% and 100% of their total account balance on their debit card. So they don't have to select funds to sell off and transfer it to multiple accounts. That is all done seamlessly for them through our HSA admin system. We also provide some online tools to our account holders to help them get the most out of their web experience and their HSA tool. One really neat thing that Epic does that most other HSA administrators can't is if we are administering the 401k plan for an employer and we also administer the HSA, the employees only have to log into one account in GoRetire to get access to both. So it's one login and they have access to both their 401k and their HSA. It really makes, keeping up with what's going on within both those accounts really easy. As I said, after the $200 cash threshold with automatic investing, we give our account holders access to around 35, 37 investment options. They include risk-based portfolios, target date funds, individual mutual funds, and they can do a customized election. They can, pick and choose whatever best they need for their investment strategy. We've got a lot of options for them. One of the individual mutual funds is a MetLife guaranteed account. That is a GIC that we get from MetLife. And we have a contract with MetLife which ends the end of September 2025. And the current interest rate, which is locked in until the end of the contract, is 3.84%. And that MetLife fund is also our default fund. So for somebody who doesn't make investment elections, their money will automatically default into that fund once they get over the $200 cash threshold. So a little more industry information. The average national HSA account balance is around $3,700. That's a low amount. And actually, if you were to take the investments out of the mix, that number would be significantly lower. But our Epic's MyHSA overall account balance is over $13,000. I think the difference is ours is sitting in an investment account, and people tend to view their money differently when they have it invested versus sitting in a checking account earning little to no interest. I've been talking about our MyHSA retail program, which is, ready to go. That's up and running. We have accounts. And if you've got business and you need to bring somebody into it, it's an easy one to do. We also offer an advisor HSA solution, which works just like our retail HSA solution, except for the advisor takes on the fiduciary responsibility of the investment lineup for their own program. Now, I don't want to go into great detail on this. If somebody is interested in this option, please reach out to your Epic consultant, and we can get a meeting scheduled. You're gonna have my email address at the end of this presentation. So if you wanted to email me and we can set up a call to talk about this in more detail, I'm happy to do that. But just know that is an option. Finally, here is a picture of our demo website, but it looks very similar to the 401k website. So it's easy, but what's important is if you look up in the upper left, you can see a drop down, and that is how account holders will toggle between their retirement plan and their HSA. So now I've got time for questions if anybody has some.
Great. Well, thank you, Paul. we're not, excuse me, we're not going to open up the floor for a few minutes of questions. So if you have something that you would like to run by us, please enter it into the question panel now. One question that I had, Paul, obviously with the new administration in place, do you think that there'll be any major changes coming down the pipeline for HSA accounts?
You know, there's some that I would like to see come down the pipeline. I think they've got enough on their plate. And HSAs, when they first came about, the first couple of years, boy, there were new regulations that hit, all the time. But that's really kind of slowed. So I don't foresee anything on the horizon, but I would love to see them change the status from an individually owned account to a joint account. I'd love to see them do something with Medicare that would allow people to continue to contribute, but those are just pipe dreams at this point. Hopefully at some point that they will pick up something like that, but at this point, nothing.
Great. We've got a couple of questions that came in through the panel. What happens when you're enrolled in Medicare? Are you still allowed to contribute? And what can retirees use the money for?
Yeah, so once somebody enrolls in Medicare, unfortunately, they cease to be eligible to contribute any more money. They still have their account, they just can't contribute to it anymore. And they can use their money for any out-of-pocket medical expenses that they have through their Medicare policy. They can still use it for dental and vision expenses, all tax-free. And they can even pay their Medicare premiums out of their HSA tax-free once they are 65 or older.
Great. And we do have one more question that came through the panel. If I have a solo practitioner, can they send contributions via payroll and get the FICA discount also?
I would encourage them to talk with their tax advisor on that. I'm not a tax expert, so my guess is, if it's solo practitioner, they probably don't have a cafeteria plan in place, and they may not be able to even participate in a cafeteria plan. It depends on the number of different circumstances. So my guess is because they're not set up in a cafeteria plan, they would have to be submitting after-tax contributions.
Okay, and the last question that we have is, what if an employee is still working and has a high deductible health plan until retirement? Is the HSA available until then?
Yes, the HSA remains available for contributions as long as the account holder meets those the first four qualifications that we talked about early on in the presentation. They have to be covered by an HSA qualified health insurance plan. They cannot have any non-qualifying insurances. They cannot be enrolled in Medicare, and they cannot be claimed as a tax dependent on anyone else's tax return. So as long as you meet those four criteria, you can continue to contribute to an HSA.
All right. Well, that wraps up the questions for today. So we would like to thank Paul and for all of you for joining us for this Epic Insight webinar. As a reminder, we will be sending out a copy of today's presentation as a follow-up. And as always, please do not hesitate to contact us if there is anything that Epic Retirement Plan Services can do to support you and your efforts. We thank you, and we look forward to seeing you again on our next edition of Epic Insight.